Hey, Daniel,
Yes.
someone was asking, are you going to go over this? But what is your business then? And what got
Yeah.
you interested?
Yeah, I'll go through, and I retitled this Straight Talk because what I found is that a lot of people kind of understand the high level idea of being involved in a real estate deal, but really where the fear and self-doubt comes in is with the little details like what's the process look like, or how do I get my money back, or what happens if I want to leave this to my kids, can I invest with a trust, all these questions that are not necessarily the high level questions, but little points that people aren't used to. So this is just an open talk. I'll go through exactly what I do and common questions that we get. So before I do that, let me also point you at meetup.intel.com. We've scheduled a variety of upcoming speakers that are here. So Mo Bina is coming in, and he's going to be talking about some of his industrial warehouse investments and a couple of gas stations that he owns as well. He's very focused on the industrial segment, and he's going to share some of that. Claude is a previous director of asset management at CrowdStreet, and he's actually here locally in Portland, so we'll get him in. Justin Smith is a development and construction professional. Actually, after Justin Smith in here, we just had scheduled Martin, who is a best-selling author on how to make your landlording go on autopilot. So he's a landlording guru and teaching tips and tricks for automating your landlording processes. And then we have some others that are a little further out. If there are any topics that you're interested in, please put them in the chat. I'll collect them, and we'll look for speakers around those topics. All right. And so I will say that in this club, I've been very fortunate to be able to bring in some great speakers. And I love hearing from them as much as you love hearing from them. I've got a lot of good feedback about it. Some people that give it 3 stars on occasion, but lots and lots of 5 stars in the meetup.intel.com app. And I have to admit that sometimes I realize that people don't know that I'm involved in real estate as well, even though I know the speakers do mention it quite a bit. But here's a little bit about me and also about why I like this club. So I started off with a double major in electrical and computer engineering. That was 1 degree, and then an economics degree at the University of California at Davis. People don't know this about me, but I purchased a seat on the Chicago Board of Trade back in 2003. And I actually stood in the 10-year Treasury note pit on the floor trading bonds for almost a year. That kind of started my intellectual journey around investing. From that point on, I actually tried to find more and more secure ways of investing and less speculative ways. I got to see the market very up close and to see the speculation that happens right at the heart of our economic system. And then ever since then, I've been moving out into more and more secure and less volatile investments. I purchased my first rental home back in 2002, purchased four others in the next 3 years. In 2004, I married my sweetheart Hillary here in Wheaton, Illinois, at a church called College Church. From 2006 to 2010, I volunteered with a faith-based nonprofit in Lyon, France. We worked with Algerian immigrants and really actually French-speaking people all over both Europe and Africa. I was the tech person with this group, and I did a lot of converting of ebooks and training materials. While we were there in France, we had to raise our own support going over, and we did that in about 10 months, which was, at least the group that we were with said that was really record-breaking time. But the other thing we did was I started purchasing mortgage notes, and I funded rehab projects remotely in the United States from France. So I learned to do, ask for inspection reports, get appraisals, find people that had track records. I started learning those skills of remotely investing all the way back in, I believe we started in 2007 doing that. Then my daughter was born, and if you're on the line, can you please mute yourself? I do hear some noise in the background. Then after that, my daughter was born in Décines-Charpieu, France, which is just outside of Lyon. She lived in France with us for 1 year, and we moved back to the US on January 1st, 2010. I started working at Intel November 1st, 2010. And from then, I started investing in LPs, in syndications as an LP in 2017. And finally, in 2018, I started Good Samaritan Capital, or as it was previously known, Elan Capital. We changed the name to better fit our core values. So that's just a little bit about me. I've really enjoyed getting to know all the people that have reached out to me. There are a lot of incredible stories and a lot of people that have side hustles here at Intel. I've been actually kind of surprised with how many people do. It's Intel people are active and intellectual. So why start a real estate investment club at Intel? Well, initially my purpose in doing this is I just wanted to find other people that enjoyed real estate investing as much as I do. So I wanted to build a little group of people that I could get to know, and people that actively discussed and helped each other in building up their own real estate portfolios. And so that was really the biggest goal in there. I love talking with people about real estate and their goals. And like I mentioned earlier, I maintain open office hours if you have questions or you just want to talk. The other thing, too, was to have a good excuse for finding some of the best speakers that are out there and inviting them in and getting to hear from them. My entire career at Intel, I've been part of the developer training community. So I'm a software developer who actually goes and does conferences, who puts on trainings, who holds a multi-day hackathons. That's been my career here at Intel for the last 10 years. And frankly, it's very similar to also talking to people about real estate. In both cases, you're communicating a technical topic, and you're trying to do it to people that may not necessarily be familiar with the material that you're going over. So I find that talking about technical things and making it approachable and easy is something I really enjoy doing, and I do have a teacher's mindset, I guess. All right, and then in the long term, I have a goal of helping 50 families reach financial independence in the next 7 years. Any questions there? All right. Before I go on to the business model, does anybody want to interject or any questions? I want to make this a discussion as much as possible. You guys can still hear me, right?
Yeah.
Hey, okay, good.
Quick question.
Daniel,
Yeah.
Hey, when you say 50 families make them financially independent, what do you mean by that? Are you helping them buy real estate or help them with financial planning?
So it is through real estate. One of my core philosophies is that by helping other people to achieve their goals, you will also achieve your goals. And so I put this out here as kind of a high level goal for the next 7 years of working with at least 50 families. And that could be through my business. Doesn't necessarily have to be through my business. It might be through just discussions. But it also means getting to know these people and continuing to have an ongoing relationship with them. So investing is the primary way that I had planned to do that.
Okay, thank you.
Hey, Daniel, just one as you go through, maybe some of you hit certain terminology, maybe kind of brief explanation, like earlier you mentioned LP. Yeah, I don't know if everybody is aware what you meant by that. So
sure. Let me skip ahead 2 slides here. We'll talk about LPs. So one of the questions that I commonly get asked about real estate syndications is just what's the business structure look like? And there's a lot of terms like LPs, like GPs, like a sponsor, like a KP. an active or a passive participant. All of these terms are somewhat interchangeable, and they're also defined by different groups. Some of them are defined in legal law as part of being an LLC. Some of them are defined by the SEC. So, for instance, these terms can be used very interchangeably, and it creates a lot of confusion. And so, part of Straight Talk here is let me just walk through what a common syndication business structure looks like and what all the different titles or terms mean. So this was one of our previous apartment complexes that we were a general partner on. Usually when you're looking at a syndication, what happens is that once you find the property and you get it under contract with the seller, you'll form an LLC in order to hold title to the property. And you can call that LLC anything you want. And if we're purchasing Oakwood Apartments, we can call it Oakwood Apartments LLC. And this LLC holds legal title to the apartment complex. And from an LLC's point of view, this LLC is set up as a manager managed LLC. You can set up LLCs either as member managed or manager managed. Member managed means that there's voting rights that are distributed amongst all the people that are within the LLC. Manager managed means that the manager has the final decision. And that might be 1 or 2 or 3 people, or it could be an LLC. So in this case, the manager of the LLC, which holds title to the building, is another LLC. And you'll often just give it the same name and call it GP LLC. And this is also a manager managed LLC with the people that are called the sponsors are the managers of this LLC. And then everybody else, all the people that are within this LLC are called the general partners. And the main difference and the reason why you split them up into 2 is because the members over here are the limited partners. So the main reason why you split them up is because the people that are in this group over here are completely passive, and they have a direct equity interest in the LLC, which holds title to the apartment. Over here, the GP LLC is entitled to a profit split from the apartments. So usually you'll talk about them in terms of being 70-30 or 80-20, whatever the profit split is, 70% going to the limited partners, 30% going to the general partners. And so the GPs that are members here are people that actually perform sweat equity. They participate in running the project, finding the project, maintaining all the broker relations in order to find projects. They do all of that sort of work over here. They're the sweat equity. And then the limited partners are the capital equity. They provide capital to the project so that units can be renovated, put back onto the market, moving them back to market rent and generating an investor return. I probably went through that really quickly. Are there any questions about this?
Can a person be GP and LP at the same time, like
Absolutely. I'm actually a GP and an LP in every single project except for one. But as a rule, I always invest as an LP in every project, and then provides labor as a GP. Actually, Oakwood was the one project that I wasn't an LP on, and the honest reason is because we raised all the money that we needed in 13 days, and I didn't get my paperwork in at time. So I was going to invest in it, but it was filled before I was able to do that. And it's a great
So
investment.
why do you need a LLC when we can just go with the individual owner name, property in the individual owner's name?
So the reason why you need the LLC is because you need to have a legal mechanism for selling equity interests in the apartment complex. All of these investors here, whether they're individuals, businesses, retirement accounts, trusts, funds, EQRPs, solo 401ks, whatever they happen to be, they own units in the LLC. When you say units, so for instance, if it was a C corporation, you would say you own shares. in the corporation, and they represent an equity interest in the business. In apartments, they're called units, and these people own an equity interest in the LLC.
Daniel,
Sorry. It looks like only when the property is owned by multiple people, or where the money is put by multiple people, then only we need a LLC. If it's an individual person, it can still be on the individual person's name instead of an LLC, or is it still should be on an LLC?
Sure. Well, an individual person can hold title to an apartment complex. Sure. There's some legal protection with having an LLC. So almost everybody who owns apartment complexes owns it through an LLC.
Daniel, just real quick.
Yeah.
For the LLC, limited protection, right?
Mhm.
Are the members or the investors or capital investors only liable for what they put in? That's all they can lose. They cannot get sued for like excess amounts or things like that.
Yes.
Is that where the GP comes into play?
Yeah,
Or-
that actually is the defining distinction between a limited partner and a general partner. Limited partners are their liability is limited to only the amount that they contribute.
Okay.
And a general partner has unlimited liability, which means, if there are problems, usually the LLC will, pay that. But in certain cases in legal law, the general partners can be responsible for more than they put into the business.
Got it. Thank you.
Daniel, do you have to have all the members up front when you set up the LLC, or once it's set up, could you add members?
You absolutely can add members. Usually, it just takes a vote of the the management of the group to add or remove members. For the most part, it on a practical level doesn't happen very often. Usually, you have them all at the beginning, at the formation, and they're set. But life events do happen. People people pass away in their family, or divorces, or college educations, or whatever it happens to be. And in cases like that, those members need to go and find somebody to buy out their, equity interest in the LLC. And so usually written into the legal framework, it says that the managers have the first right to purchase. So if somebody is trying to, sell their share in the LLC, the managers have the right to purchase it first. And the reason why that is because you don't want somebody in the LLC selling to somebody that the managers don't know, and then potentially bringing maybe a person who likes to file lawsuits into the business. So you have to be very careful. Also, the SEC requires that the managers know all of the people that are investing in their business if it's a 506B LLC, which is it's a type of LLC that is not allowed to publicly advertise. All of their investors are people that they've gotten to know over the phone or in person.
So if we are a group of people, we are trying to invest in a syndication, what do you recommend? That we form a LLC and invest on that name?
No, actually. So for limited partners here, because the LLC classifies you as a limited partner, you have legal protections. If somebody were to slip and fall on the property, you're not going to be the one that's going to be sued. The LLC would be sued. So you have the LLC's protections just by being a limited partner. Now, having said that, some people do invest through their own businesses because maybe there are multiple people on the board of director of their businesses. Maybe they put their kids. I invested with Whitney Sewell, who was a previous person who came into this club here, and we had my kids' educational funds. I took $14,000 from each of my 3 children, and instead of putting it into an educational account, I put it into a partnership. The minimum to invest in his syndication was $50,000. So I took the 14 from my 3 kids. I threw in another 8,000 that was us, and we had an ownership interest that was divided by those ratios in the income that we would receive from that investment. So one reason you might want to invest as a business here is that if you want to split the income that's coming out of it with multiple people. And in the case of my children are obviously in a lower tax bracket than I am. So they get taxed at their rates, which is exactly why I wanted to pass the income through to them.
Hey, Daniel, you're going to go over, like sometimes I guess you don't win all the time. Sometimes you win, sometimes you lose, right?
Yeah, let's talk about that. Okay. So let me jump down to, I'm jumping all around now, but let me jump down to, these are the properties that Good Samaritan Capital currently is a general partner in. And we actually just refinanced this one right here, Houston. We're done with the renovation plan. We just refinanced it. We're returning 50% of investors' capital back to them today, and another 33% over the next 2 months. So their investors are getting, 80% plus of their capital back and still maintaining their equity ownership. So with each of these properties, so far they've all done well, with the exception of Memphis right here. So I believe that when people are investing, it's a real world sport, and whenever you run into problems, you need to be as transparent as possible. This particular property is the first property that I've had some issues with, and I think that they are fairly well handled now. But the story is that our asset manager that we had hired to look over this property and to oversee the renovations, he found a better opportunity and, left. And so suddenly we were left with, okay, we need to find another person in order to step in and take the asset management position. That wasn't difficult. What was difficult was that he had actually used some of the funds in the budget for the hallways. He had used them on the interior renovations, which you're not supposed to do. The reason you're not supposed to do that is because when you close on an apartment complex, the bank will actually hold an escrow all of your renovation funds. And then you, as the syndication, you have to pay out of pocket for those renovation funds and then submit reimbursements to the bank. So the bank has oversight in your process here. And when they see something like funds from the hallway were used on the interior, they start an internal process. So we looked at this and we went to the bank and said, okay, well, let's get we had actually done $396,000 worth of renovations that we wanted to be reimbursed for here. And we had contractors and suppliers that needed to be reimbursed. And so we went to the bank, and the bank said, you know what, we see an irregularity here. So we want to be able to look over all your books. We want to do a BOV, which is a lightweight appraisal. It's a statement of value. We want to check over everything before we approve the reimbursement. And so what that left us with was a temporary cash crunch. And due to that temporary cash crunch, we delayed distributions on this, and they've been delayed for several months now. So we actually did get those. So once we got through the cash crunch, what we needed to do to get through the cash crunch was the general partners came together, and we contributed collectively $300,000 to the business in order to make up for that temporary cash flow crunch. And is a situation that I'm very glad, it didn't go out to the investors. There was no capital call for the regular investors. The capital call was for the general partners who put their money in first. And so we collectively put in a little over $300,000. That made up for the temporary cash flow shortage. We paid off our contractors and our suppliers. We then went through the process with the bank, which took about 2.5 to 3 months. And the bank has finally reimbursed us as well. And so we're in the process of paying back the loans that the general partners put in. And we are currently, because we were able to keep renovations going, at 88% of occupancy. And once we reach 90% of occupancy, we'll be able to refinance and return some capital to the investors and to continue with distributions. So this has been the one project that's been interesting for us because it's the first one where we've run into a major issue.
Hey, Daniel, by any chance, are you able to share the project cost and how much general partner put in, how much limited partner put in, or you can't discuss it here?
Yeah, usually, people like to keep their own contributions private. So unless you're part of the syndication, or you specifically ask people there, but we're not in the habit of sharing the financial information of the members.
Yeah,
and Daniel, sorry, in this case, for the partner that left the property, did you guys take any legal action against him for the mishap that occurred between the use of the funds, for the misuse of the funds?
No, we haven't taken any legal action against him.
Is this a case where you can take legal action? Because he's going to another property, right? And he might do the same thing again. So that's like,
yeah,
that's I don't know how to phrase it, but you know what I'm trying to say. For the next group of limited partners that might work with him, something might occur with them. So
yeah, so I would have to talk to a lawyer if that's even possible. It probably is. You can sue over anything. I don't tend to be a person who wants to do that. So
but
we'll never do business with him again, obviously. And he's no longer part of the syndication. But we're not pursuing him legally.
Yeah.
Frankly, the situation was corrected by the GPs putting in a temporary infusion of cash. And even though the distributions for the limited partners were delayed on Memphis, they're still accruing what's called a cumulative preferred return, which in the case of Memphis is 8% per year. And so even though we haven't distributed that money, we still owe them that 8%. So they're not losing money. They're just not receiving it as soon as we had originally thought we could give it out.
Hey, Daniel, question about the finances, if you can. Let's say you have a project, right? And I assume everyone puts, like I say, money, you have $100 total, right? Then you use that some other money to purchase a apartment complex, to manage it, et cetera. At what point, what are the distributions like? Like, do you do make sure all the costs are paid off first, and then after that, then the profits are shared? Or how does the distribution go?
So what's the order of distributions?
Yeah.
Yes. So let's see. Did I put anything up here about it? No, I didn't actually. Do this. Okay. So basically the order of distributions in almost any syndication, these are kind of industry standards, are that the limited partners will get a cumulative preferred return. That's the 8% that I just mentioned with Memphis, for instance. And the other number is, of course, the cash flow amount. So with Memphis, I don't remember off the top of my head, it was about a 10% cash flow, I think, that we had projected for it. And then the IRR, which is the cash flow plus any equity upside over the lifetime of the property. So the order in which that goes first is limited partners get 8% on their money first. Limited partners, when you're looking at the LLCs here, they actually hold Class A shares with the highest rights. And then the general partners hold Class B shares with slightly lower priority. And so these people over here get paid their 8% first. And if this property never performs over 8%, then the limited partners are the only people that get any money from the cash flow and equity. Once it's over 8%, there's a split that comes into play. And in the case of Memphis, I believe it was a 70-30 split. My first two syndications were 80-20 splits, and everything since then has been 70-30 splits. And so once that 8% is paid out, the profits are shared 70% here, 30% here. Does that answer your question?
Yes, and then so after a while, everyone gets the money back, right? then after that it's just like free cash flow per se, or do you guys like end it, or what's the end? How do you end this whole thing?
So there's a couple of different exit strategies. The most common one is that the renovation, starts as soon as the purchase takes place. Usually takes about 1.5 to 2 years to complete. During that time, about 6 months to 9 months out, that's when distributions will start, because you've renovated some units during that time, put them back onto the market, and you're getting an investor return. So from that investor return, you can start giving distributions. Then once the unit renovation is completed, the banks want to see a 6-month track record of the property performing at a higher NOI, net operating income. And so once you can prove to the bank that you have a 6-month record, banks will begin lending to you. So at that point, you can refinance. And refinancing, depending on the project, might return, it'll return some percentage of your original capital to you. We've had one where just 11 months into the project, we refinanced and returned 21% of the capital to partners. And this Camino del Sol, which our refinance actually closed today, we're returning 50 plus 33 over the next 2 months. So it obviously would be kind of a holy grail in order to improve the apartment so much that the banks would lend to you a large enough amount that you could repay 100% of the investor capital. If you can do that, you have, what Robert Kiyosaki and others call your infinite return. You've got no money in the deal, but you're still getting cash flow. Usually you don't get an infinite return from these. Usually you'll get 50% of your money back, 80% of your money back, 20% depends. But usually a percentage you'll get back after renovations. And then from years 3 to 5, the operating income will improve until you get to a point where you want to sell. And then when you sell, of course, that's when everything is divided up according to the percentage that each person owns. That answer your question?
Yeah, but then so I understand what you said, but then the exit strategy, do the investors at a point just exit, just like sell the shares and get out, or do they typically hang on to the life of the project?
Typically, it's a non-liquid investment, and you have to hold on until the end of the project.
Okay, thank you.
Yeah, and going in, that should be something that's very clear.
And a passive or limited partner doesn't get to decide.
Yep, passive partners are not the managers. They do not have the right to decide. Now they can sell their own interest to the general partners, and if the general partners decline, they can sell it to other people within the LLC usually. And then if that fails, they could find an outside buyer and introduce them to the management. And if the management okays it, they could bring them in. So those are situations that do occur, but they're rare.
Hey Daniel, how do you compare this apartment investing in this manner with, say, if I go and buy investment property? Are there like more from a bank perspective? Is there more interest rate for apartment lending that the bank charge compared to maybe a single family home that I would go ahead?
Yeah, the loans are actually significantly different. Although your main advantages aren't necessarily, well, there are some advantages in the loans. The main advantages are more in taxes. In the loans, commercial loans usually have a lifetime of 7 to 12 years, rather than your typical, 15-year fixed or 30-year fixed that you get for a residential mortgage. And because of that, a lot of banks know that you have a business, you're looking to renovate a property. And so one of the nice advantages to these loans is that they often include what's called IO, or interest-only payments. And so you can negotiate a loan with the bank to have 1 or 2 or even on Oakwood, we actually got 4 years of interest-only payments. And the reason why that's advantageous is because obviously if we're only paying interest-only payments to the bank during the renovation, that frees up our cash flow so that we can renovate units faster and get to sending back distributions faster.
From an interest rate perspective, Daniel, like any idea?
It's pretty typical. From an interest rate perspective, it's not that different than a residential mortgage. So we have fixed mortgages on most of these that are they're around 3% right now.
Hey, Daniel.
Thanks.
Hi, Daniel. Quick question. When you're arranging your financing, do you generally like go through a commercial loan broker, or do you go,
Absolutely.
or do you work with? Do you have a handful and you just kind of go that route? Yeah.
Actually, we work with one particular. Her name is Brandy Shotwell. But I can, you can look her up. Her Brandy with an I at the end, Shotwell. Her company is called Recon Capital, and she does a great job. So we use her.
Ah, cool.
Daniel, quick question. What's the typical investor size as in, like, let's say in the limited partner, how many typically do you have? You have like 7 properties or 6 properties you listed. So what's the typical people size of the LPs versus the GPs?
So it's actually broken up in the legal paperwork. So 70% of the ownership is held by this LLC, 30% is held by this. I
get it.
Okay.
My question is more on, like, let's say, do you typically have, like, do you invite like 15 to 20 limited partners and like 5 to 6 in the GP size, or it's like 50 and 15? How do you typically?
Yeah, it kind of depends. So for the majority of these, we funded the equity side of the deal with individual investors. Sarasota, Florida was a little different. In this particular case, this was a $25 million property. And so we had about a $10 million raise that we needed to do. So we actually went out to private equity, and a private equity firm came in for $6 million of it, and then we raised the other $4 from individual investors. So typically the thing that would determine how many people are in the deal is the minimum investment size. So for most of these, it's been $75K. But it varies based on which syndicator you are, which deal you have. I believe Fort Smith was a $50K minimum. And we've made allowances for people who just wanted to bid $50K rather than the $75K. So on most of these, we'll tend to have 30 to 50 individual investors per deal.
And then the decision on the general partners, that's made by you based on, like, how do you know them, their paperwork, or how do you decide?
How do we decide?
How do you decide, like, okay, this member can be a general member, or let's say you don't know me right now, right? All you know is, like, okay, Shekhar works at Intel, good. And I ask, like, okay, Daniel, I want to be a general partner.
Mm-hmm.
Then what's the framework you try to go through to say, yep, I trust on this guy enough that it looks good?
Yeah. And I think more generally, your question, 2 questions here I'm sensing. One is how do the general partners choose each other?
Mm-hmm.
And then the other one is, what's the on-ramp for doing that?
Yeah.
Okay. So to speak to the first question, the way that I've gotten to know a lot of these people is, frankly, just by going and finding them. If you haven't figured this out by now, I like to network with people. So going out and finding other people who actually have businesses that are doing this and have a track record that they can show. So number 1, that's most important. You need to know that they're actually in it and they have a track record. So a lot of times how this works out practically, and I'll come back to the second question. A brief answer on the second question is that if you are interested in becoming a co-GP, which is the word for people that are in the general partnership but are not the managers of the general partnership, if you're interested in doing that, Really what you need to do is you need to go find people that are doing syndications and get to know them and show that you can perform basically one of these tasks right here. The co-GPs and the GPs do broker relations. They do underwriting and financial modeling. They come up with the value add business plan and the investor thesis, manage the renovation team, raise investor capital, work with legal, CPA, and tax professionals, manage the property management team, fly to the property, walk through it with inspectors before it's purchased, and do the financial due diligence on it as well. Continue to monitor the status of the business plan throughout the lifetime. And finally, at the end, refinance and sell. So these are all active tasks. And really what you need to do is you need to find somebody who's already doing this and, find somebody who's willing to take you on as a small general partner. And people always start off with small amounts in the general partnership at first, and then they work their way up. So for instance, in each of these buildings that are here, most of these buildings, I'm in the general partnership, but I only have, 4 to 5% of any particular, investment that's here. And I've been converting my own, stock market portfolio into these investments. So it's not like our group owns these outright. We're just another member of the syndication.
Got it.
Daniel,
Thank you.
I just want to mention your point in the co-GP responsibilities. To be a GP, you cannot just satisfy raising investor capital.
That is true. Yeah, so the SEC wants to make sure that people that are in the general partnership participate throughout the lifetime of the business. Any role which is considered to be raising capital and then ends at the closing time is actually considered to be an illegal broker. You're a broker operating without a license. And the SEC will come after you for that. There's been some pretty high-profile cases of Ashcroft Capital and others who are doing that the SEC pursued them. And so if you want to be a general partner, you do have to find other things that you can do as well and participate in that, throughout the life cycle of the property. For each of these properties here, I attend a asset management call once a week.
Hey, Daniel.
Yeah.
What about the other side? Let's say we want to be in the investors, in the LP side, to join your group. How would you go about, vetting us or accepting us to be your investor?
Yeah. So first of all, the SEC requires that we get to know you and get to know your goals, basically. And if the goals are aligned, probably the most important thing is just having an understanding of how the business works. So knowing, distributions start 6 to 9 months after the closing date, knowing the refinance events, knowing, the whole business is to purchase an apartment and raise the value of it so you can give an investor return. The SEC qualifies those people. There's actually a term for them. It's called a sophisticated investor. And sophisticated investors are investors who understand the investment that they're getting into, but they don't qualify to be an accredited investor. And an accredited investor, the SEC defines as having a certain net worth or a certain income. It's actually $1 million net worth, not including your primary residence, or $200,000 for 2 years in a row as a single person, or $300,000 as a joint couple for 2 years in a row, with the reasonable expectation that you will continue that in the future. So being an accredited investor is a monetary requirement. And if you don't meet that monetary requirement, you can still participate as a sophisticated investor. The main qualification is really that you just understand the business plan and you have aligned goals.
Okay. So let's say for your next project, we're interested, do we just contact you or how do you get
absolutely. Yep, sure.
Okay.
I talk to people all the time, one-on-one, and if you're interested, give me a call.
What is the benefit of accredited investor versus substitute?
Well, in The benefit is actually more to the people running the business. So there's two common types of syndications. One I already mentioned is a 506B syndication. That number comes because the SEC regulations for this type of syndication are in Section D of the Securities Act, Section 106B or 506B. Basically, that syndication allows us to take in 35 non-accredited investors, or any syndicator to take in 35 non-accredited investors, and an unlimited number of accredited investors. The drawback to this particular type is that we're not allowed to advertise. And the reason the SEC does this is because they want to protect unsophisticated investors. They want, people who are getting into these more sophisticated investments to be accredited, or at least to be sophisticated. And so it's the SEC's way of protecting the general public from potentially predatory syndicators. Now the other type of syndication is a 506C syndication, and the 506C is allowed to publicly advertise. You can put a Facebook ad up for your apartment complex, but all the people that join that must be accredited, and that you actually have to go through a verification process that's more than just the GP or more than just the LP saying that they are accredited. You have to actually go and verify their bank account records. Usually you have a third party do that.
So you guys are 6B or C?
B.
So Daniel, for that accreditation, then you go to third party. So third party would verify and say, XYZ person is accredited, therefore you can continue business with them. And then that certificate or whatever, does that go with them so they can go anywhere, or do you have to do it every time?
I think it's valid for a certain amount of time, and you can use it anywhere. You might have to look that up.
Okay.
But there's several businesses out there, Verify, Accredited, and others who will basically go through and verify if a person's accredited or not, and then let both parties know.
Hey Daniel, the service that I use has it for 3 months, so it's valid for 3 months, and then after that you've got to reapply or reassess.
Excellent, thank you.
So Daniel, regarding this accredited investor, but let us say we are investing as part of LLC, how does it work? How it does work?
Oh, so the accreditation standards for an LLC are different. They're spelled out in the same area of the SEC code. I believe if you're an LLC, you need to have a net worth of over $5 million to be considered accredited. Otherwise, you're sophisticated. And there's some other rules and regulations there as well for qualifying different types of groups.
So if it is LLC, it is a different criteria.
It's a different criteria, yeah.
Oh, okay.
Hey, Daniel, if you have time, how do you go about finding this new investments or ideas?
Oh, yeah. So broker relations is frankly the most time-consuming thing here. And so I don't do any broker relationships whatsoever because I've got a day job at Intel, and frankly, broker relations is pretty much a full-time job. So I know certain people, and I have relationships with certain people in this business who are called owner-operators. And they basically go and talk to brokers, and brokers will send them 10 or 20 deals a week. And they go through the underwriting and financial modeling of these deals. Now, once they find one that meets their investment criteria, which in our case is a minimum of a 15% IRR and a 10% cash on cash, and in an area that is growing, we've got a couple of demographic criteria as well. But once you find a property that's in that section, those people, they're going to be the managers right here of their GP, and they go about recruiting other people that are going to be GP members that'll actually work with them. And usually these are people that we already know, that we've done deals with before. We know that they perform. We know they're reliable. So people that you have pre-existing relationships with, you then invite into the general partnership. And usually that happens right here at, sorry, jumping around again. that often happens right here at just before physical and financial due diligence happens. So they'll form together their team, and then oftentimes we all go fly over to the property and walk through the property with the inspectors. We usually have the renovation team there, so they can give their input into what needs to be renovated and what doesn't. After we go through and do the walkthrough, we'll sit down, just in the lobby and create a business plan for these apartments need to have these things fixed. The playground needs to be fixed. The tennis court needs to be teared down, whatever it happens to be. So that team gets together, and also the physical due diligence is a great time just for the team to physically meet up. A lot of us are in different locations. So we all meet up there. And then we go back, and some people work with raising investor capital. The managers will usually work with the lending people and the tax professionals and the CPAs. And you have to go through and get your project to the point at which you can fund it and close on it. So that's often what happens. So the people that find the deal will invite others in that they've already worked on teams with.
Okay. And then part of that due diligence is also looking at the risk, right? Like, what if we don't meet the numbers or whatever? They do all that assessment for you ahead of time.
Well, the underwriting model actually does change because as you're just after due diligence, you start negotiating with lenders, and lenders, whatever their criteria are, will go back and affect the financial modeling. So there's a little bit of give and take here before the property closes of, potentially the cash on cash going up or down, or things in the business needing to change a little bit. But once the property's purchased, the plan's in place.
Okay. Now, sorry, one more question. Yeah. On the other side, if you're on the LP side now, what do you recommend? Do you recommend just investing under your name, investing on an LLC, or through other investment activities?
People most commonly invest in their own name, which is fine. There have been a couple of people that have invested through family trusts, for instance, or their retirement accounts. That's most common.
Okay, and then if you do that, then you get the K1 schedule. Is that what they get, or what do they get?
Yes, yeah. So at the end, I think I put this right here. From the LP's point of view, every year you get a K1 partnership return, which if you're a member of any partnerships or LLCs, you're familiar with this tax form. It's basically just the partnership telling you your share of the profit and loss, and then you have to report that on your taxes.
Okay, thank you.
Can you quickly go over kind of the tax implications or the advantages there?
Yeah, so there's two large advantages to syndication taxes, and they both boil down to being able to front load a lot of the depreciation into the first year. So normally with the property, the IRS allows you to depreciate your rental home over a 27.5-year period. However, with a syndication, there's two different ways that you can front load that. The first one's called a cost segregation study. You can go Google that. There's lots of articles on it. But basically, cost segregation is where a specialist in both accounting and construction will come in and say, hey, the carpet is not going to last 27.5 years. The IRS says that we're allowed to depreciate that over a 7-year timeline. And the copper wiring in the wall is going to last for, all 27.5 years. The doorknob's going to last for 15. So, and they literally have this list of hundreds of items that they will break your property down into. Everything from the stucco on the wall, the light switches, everything. And they assign some of them an accelerated depreciation scale. And so that allows you to take a lot of that depreciation in the first year, which for all practical purposes usually wipes out all your taxes on the cash flow. The other way is called bonus depreciation. You can Google that term too, or search it. DuckDuckGo it. Bonus depreciation is a little more complicated, and it takes a CPA in order to calculate it, but it also lets you take a lot of the depreciation in the first year. So To give you a practical example of this, my very first LP investment, I put 75,000 into a 56 unit down in Texas. And in my first year, I got a K1 form where I received an 8% preferred return. So I got $6,000 that year. And then I also received depreciation, and I received $61,000 of depreciation. So that $61,000 wiped out any taxes for the $6,000 in income that I had. And then I had $55,000 depreciation, which rolled over to the next year and wiped out the next year's cash flowing taxes. So the advantage there is that a lot of the cash flow is usually tax-free. However, at the end of the property, when it's sold, there usually are capital gains taxes to account for. All right, looks like we are out of time, and I've just been talking nonstop. I hope this has given some of you a little more insight into me and my motivations and goals. And I hear your question, whoever that is. I can stay on afterwards and we can talk.
Yeah, just a quick question. So how long normally these properties are kept?
Usually 4 to 7 years.
4 to 7 years, yeah. Thank you.
So Daniel, so you bought rental for your own, and you basically did rental. Yeah. Now, if I ask you, compared to syndication versus just be an individual property owner renting stuff like that, what do you think is good for you or good for people? How do you compare the two scenario? I mean, the profitability is better for for individual ownership and just doing it. The rate of return might be better, but also it comes with a lot of headache, right? So what is your thought process in this case?
If you want to be a truly passive investor, this is a way to be truly passive, but it also means you have no voting rights also. If you like to do it yourself, rental houses are good. They're not quite as tax advantaged. They're going to be a little more work. And my biggest problem with them is if there are any significant repairs, they tend to wipe out your cash flow for large periods of time. So that's one of the reasons why I like apartments better. The other reason is that it's more scalable. When you've got property management, when you've got one person or one group to talk to for property management, that's a whole lot better than talking to a property manager for each rental home that you have. So it's more scalable as well. Those are the two major advantages.
And you like this better over the other one because you have done both, right?
I've done both. I prefer this, but I also like to be active. Not everybody does. So it depends on how active or how passive you want to be.
And that's why you are GP also. I mean, your GP is kind of like your activity more than LP.
Yeah. I enjoy being involved in it. All right. That's all we have for today. Hey, there's 11 people in the meeting. Oh no, 134. Never mind.
At the exit, Daniel, is it
all right?
Capital gains or will it be ordinary income from a tax?
It's capital gains on exit.
Can you maybe one last question? Can you please, from LP point of view, explain how you kind of evaluate and how you what are the recommendations to evaluate this kind of a deal? Or do
you know what? I will point you to a Yammer post I did a few weeks ago. I went online to my entire process. But basically you need to do your own due diligence. And I gave my criteria in terms of what I want to see in a location. So the demographics, the population needs to be increasing, the median home value, the median income value, and the crime rate needs to be decreasing. So I listed my criteria on Yammer. But basically, the most important thing is you have to know and trust the operator because they're the ones making the decisions. They need to have a track record. And they need to be purchasing in an area that is demographically beneficial, and they need to have a good business plan and data to back up their business plan. I can send you a sample deal if you want to look at it. I have a sample deal that I send out to people just so they can get used to. Email me if you want me to do that.
Cool, thank you.
All right. Thanks, everyone. Have a wonderful weekend.
Thank you.
Thanks, Daniel.
Thank
You too,
you.
Daniel.
Daniel.
Thank you.
Thank you.
Thanks, Daniel. Great job.
Thanks, Daniel.